Over the past 5 years, the cost of everyday goods and services in the US has risen by more than 25% on average. Eggs that in 2020 cost $1 now cost $3 or $4. Gasoline prices have doubled and home prices surged to record highs. This has been one of the steepest 5-year increases in living costs in over 30 years, even higher than before the global financial crisis in the 1990 recession. So it's no surprise that recent surveys show nearly half of Americans now say the cost of living feels worse than ever. And yet, headline inflation tells a very different story. It has fallen sharply since its 2022 peak and is now sitting around 2.7%. That gap matters because the last time we saw an affordability squeeze like this was 1971. Back then, headline inflation had also cooled to around 3%, but prices didn't stop rising. Instead, inflation surged again, eventually reaching nearly 15%, and the economy fell into a deep recession. If today follows the same path, that of course could have devastating economic consequences and impacts on financial markets. But to see whether that's probable, we need to break it down into its components. Because if inflation is about to re-accelerate, it has to come from somewhere. One place people often go to is core goods, especially with tariffs back in focus. And indeed, after contributing almost nothing to inflation for a couple of years, core goods prices have started rising again. That includes everyday items like cars, appliances, and household products. But when you look closer, economists tend to agree on one thing. Tariffs usually create one-time price increases, not the kind of persistent inflation that keeps compounding year after year. And just as importantly, core goods typically make up a relatively small share of overall inflation. The largest inflation component throughout the year, including today, actually comes from shelter, which means if inflation were about to re-accelerate, this is where it would most certainly show up. But when we look at the data, the picture doesn't point in that direction. Yes, home prices surged after 2020, but over the past 3 years, they've largely stalled. A renewed inflation spike would require housing prices to start accelerating again. But with affordability already stretched, mortgage rates still elevated, and housing demand sitting near levels last seen during the depths of the global financial crisis, it's hard to see prices suddenly taking off from here. So even the largest component of inflation, shelter, isn't currently signaling a renewed surge. But even though shelter is the largest part of inflation, it's not the only force that matters. In fact, the last major inflation surge in 2021 and 2022 was driven largely by energy prices, especially oil. While energy may not always carry the largest weighting, its sharp price swings tend to move inflation quickly in either direction. You can see this clearly when we overlay oil prices with the inflation rate. Many of the sharp inflation spikes over the past few decades, including the 1970s, line up almost perfectly with periods of rising energy prices. And that makes sense. When oil prices rise, fuel gets more expensive, shipping costs jump, factories face higher input costs, and those increases eventually show up in consumer prices. So it's possible that the next wave of inflation could result from another spike in energy prices. But like any commodity, oil prices ultimately come down to supply and demand. When demand runs hot and supply can't keep up, prices jump quickly. But when supply is abundant and demand cools, prices tend to stay contained. And today, that's exactly what we're seeing. Global oil supply remains strong, while demand growth has fallen behind since 2024, with forecasts suggesting that trend could continue into 2026, which means that, for now, energy isn't sending a clear inflation warning either. So when you put all of this together, most of the usual inflation drivers are actually pointing in the same direction. Shelter isn't accelerating, core goods look more like a one-off adjustment than a sustained trend, and energy, for now, isn't sending a strong warning signal either. However, there's still one powerful macro force that could reverse all of these trends and turn inflation back higher. That is money creation. This chart shows the growth rate of the money supply. When this line rises, it means more money is being created and injected into the economy. When it falls, liquidity is being withdrawn and financial conditions tighten. Back in 2021, the Federal Reserve dramatically expanded the money supply to support the economy. Money growth surged to more than 20% per year, an extreme level by historical standards. And when we overlay that with inflation, a clear pattern emerges. Rapid money supply growth tends to lead inflation by about a year. When more money floods the system, it doesn't instantly show up in prices, but over time, that excess liquidity boosts demand. Households spend more, asset prices rise, and eventually businesses raise prices. That's exactly what we saw after 2021. The same pattern played out during the inflationary 1970s, when money supply growth climbed toward 15% and was followed by a prolonged surge in inflation. The mechanism is always similar. The Fed creates money through a process called quantitative easing, buying government bonds with newly created dollars, increasing the amount of cash circulating in the economy. And today, while money growth has cooled significantly from from its peak, the Fed has already signaled the same policy shift. They've announced roughly $40 billion in bond purchases each month starting in December. If those purchases expand and money growth starts accelerating again from here, that could be the one development capable of reversing the current disinflation trend. And that of course matters to the financial markets because historically rising inflation rates typically coincide with tighter financial conditions and meaningful market drawdowns. So if inflation were to turn back up from here, driven by renewed money creation, that risk would come back into focus, which is why, for investors, it's no longer enough to just watch the headline inflation number. The real signal lies underneath, in the components of inflation and in the pace of money supply growth. At Capital.com, we'll continue following how inflation components and money supply interact to shape the economy and what it all means for investors. Hit like and subscribe to stay tuned. Thanks for watching.